Good evening, ladies and gentlemen, and thank you very much for spending your evening with us. I'm delighted to talk about my favourite subject, which is equity income investing and the art and science of it. I'll start with what we call the equity income paradox, which is that you might think that if you get less income from a share today, you would get a better return in the long term. But actually, that's not the case. Companies that pay the highest yield give you the highest total return in the long term as well. So we think this is, the best of both worlds. You can get more income today and more return later on. And I'll show you quite a bit of evidence for that, and then I'll talk about how we try and pick stocks at Allianz Global Investors. So this study is very well known by 3 professors from the London Business School. They put £1 in the market, theoretically, in 1900, and over 114 years, that pound grew to £30,000 with dividends reinvested. If at the beginning of each year, instead of buying the top 100 companies, you bought the 50 with the highest dividend yield, your pound would have grown, and changed that the following year. Your pound would have grown to £126,000. You would quite simply have outperformed the market by about 1.5% per annum by doing nothing more complicated than buying the highest yielding shares each year. Now, you might think, well, that's fine, but presumably that's quite a risky strategy, quite volatile, doesn't work in every environment. And that would be true. So the next thing they looked at is, well, let's look at the individual years. These grey bars at the individual years show the performance of a high-yield portfolio compared to the average each year. And the high yield, they move around quite a lot. And you can see here the high-yield portfolio in orange, £125,000, £126,000, and the low-yield portfolio. If you simply bought that, you'd end up with £4,500 over 114 years. But the most interesting line of all here is this dark blue line, which is the 5-year rolling returns. So if you invest for 5 years, for about for 80 or 90 years, there was never a 5-year period where you'd do worse off from buying the high-yield strategy, high-yield equities versus the lower-yielding ones. And in fact, even when it did underperform for 5 years, you normally got quite a quick bounce back. So over quite a long period of time, it's generally been a pretty good strategy to buy high-yielding shares. And if it hasn't worked in every environment, it has usually bounced back pretty quickly. Further, you might then say, well, okay, we know high-yield shares do better than low-yield shares, but which are the best shares to own? And actually, it's quite interesting. You break the market down into 5 quintiles of 20% of each. And actually, pretty much the highest yielding shares give you the best return, the next, and so on, with the lowest yielding shares giving you the bottom return. But what's interesting is you'll see this period here, technology, media, and telecoms bubble. Many of you will remember, late 1990s, we had this phenomenal period where you just had to mention the word internet and your shares went absolutely through the roof. There was a company called Telecom, which was worth 500 million in 1998, 24 billion in 2000, March 2000. It's never yet paid a dividend as far as I'm aware. But clearly, these zero dividend yield shares had a phenomenal run at that point in time. Despite that period, you were still worse off, even back from 1994, owning those low-yield shares rather than high-yielding shares. So why is this? I'll go back. I think as an investor, it's great to know something has worked in the past, but I always want to know why it's worked and why it will work in the future. So I say, well, what are the reasons why high-yielding shares have outperformed? I think the first is that high-yielding shares is a type of value investing, and we've been hearing about Warren Buffett and Benjamin Graham, the fathers of value investing. If you buy companies when they're lowly priced, out of favour, and with a high yield, you normally get a better return. And I think high-yield investing is one type of value investing. I think a more subtle reason is that the companies with a high yield tend to be well-established businesses. They've been around a while. They've been through the economic cycle and survived. They're in a position now where they're generating surplus cash, which they don't need just to reinvest in the business and keep it going. And so these businesses tend to be around for a while. They tend not to be the most highly rated. And very often investors love to buy the new story, the next idea, the next great growth concept. These companies often aren't those type of stocks, but they do deliver quite well in the medium to long term. And thirdly, and one of my favorite reasons, I think, is that the management of high-income shares, high-income companies, are under enormous financial pressure, great discipline. They know they've got to pay out money every year to shareholders, and that puts quite a strain on any surplus capital. They know they have to spend it wisely. That gives them less capital, and we actually know that company management aren't necessarily, on average, good at allocating capital. When they do mergers and acquisitions, when they do takeovers, often they destroy value. So actually having a tight discipline, I think, is another reason why high income shares do quite well over time. So that's I was asked earlier actually whether you're better off with the global income or the UK. We think the UK is a pretty good place to be actually. For a start, you can see that the UK has historically offered a greater proportion of the market has a high yield in the UK than many other regions around the world. And there's a great culture, a great history of high yielding shares in the UK. I think whilst if you go into the continent of Europe, many companies have a high dividend yield. I think even now, even still today, it's much more regular, much more often you'll see a company where the profits dip and they reduce the dividend a little bit. In the UK, if a chief executive cuts the dividend, very often they lose their job at the same time. Not necessarily the right thing to do, but that's the culture we have in the UK. We also have a great legal and corporate governance framework in the UK, which is very powerful. And we have the takeover panel, which ensures fair play. And of course, the UK is a very global nation. We've been a trading nation for an awfully long time. And so UK companies, about 70% of the sales of the FTSE 100 are in overseas markets. So from the UK, you can get great exposure to the world economies and world industries, but with a good corporate governance and framework and legal structure. So how do we do it? Well, we take this idea that high-yielding shares perform, and we apply that. We try and look for companies that have a good yield, but we never say the yield in itself is a reason for buying a share. We always look at the total return we think we can get from a company. And equally, we don't sell a share if the yield drops below the market. So if a company's share price goes up and the yield drops mathematically, we don't automatically sell the share. We will reassess. Or if a company cuts the dividend, sometimes a dividend cut can be part of a turnaround strategy and you can get strong results. So we have a very specific way we look at income. We like companies with a yield, but that never drives the decision. Just briefly on the Merchants Trust, and then I'll say a bit more about stock selection. The Merchants Trust, as many of you all know, has a high dividend yield, about 4.9%, one of the highest in the sector. We have raised the dividend, or the board has raised the dividend every year for 33 years. And it's an actively managed, high-conviction portfolio. And it's delivered strong performance. We are geared. We have borrowings which gear up the return, both in a good way and a bad way, if the markets go up or down. And we have been issuing shares in the last 12, 18 months in response to strong demand from investors. The management fee is very low, 0.35%, and the total ongoing charge is about 0.6%. So it's a very commercial, very competitive way to invest. In terms of what I look for when I buy a company, I ask 3 questions of a business. How good a business is it? And that's the fundamentals. How strong a company? What's the competitive position? How attractive is the industry? And so on. How good is the management team? What's the corporate governance strategy? How cheap is it? We look at the valuation, both compared to its own history and compared to other companies we can invest in. And we ask, what's going to change? And this is really important. If you're buying cheap companies that are out of favour, often companies are out of favour and cheap for a reason. And you have to identify those companies that have structural problems and separate those from companies that are just temporarily depressed, where the market's got overly concerned. In terms of when we sell a share, if it reaches our target price, if something changes in the investment case, or if we find better opportunities elsewhere. And in practice, it's often a combination of those factors. Let me give you an example. Hansteen, you may not know Hansteen Holdings, it's an industrial property company. These are the sort of grey sheds you'll see in industrial complexes around the country. Actually, half the portfolio is in Germany. The management team are incredibly active. They all buy portfolios of property that might have 20, 25% voids. And they'll get in there, they'll find new tenants, they'll work with their existing tenants, and they'll try and let that space as quickly as possible, and then sell those properties on to other investors. They buy properties that are really cheap. Typically, their average property is about 50% of replacement value. So they're buying. It's not economic to build more properties where these properties are located, because you can buy the existing properties much cheaper than the cost you to replace them. The management team, as I say, they're very active. They actually sold their last property company called Ashten, 2006, near the top of the previous cycle. And they have no intention of owning the whole property throughout the cycle. They intend to sell this one on or realise as much as they can of it at the right point in the cycle. And they're trying to do in Germany what they basically did in the UK, which is almost create the industrial property sector for institutional investors. So it's a good company fundamentally. In terms of valuation, the assets, the property yields, it's quite interesting because much of property has been revalued as most income investments have been revalued. Property values have gone up, property yields have dropped. And you can see this with prime industrial property yields. They've come right down to where they were at the peak of the last cycle. But the top end, the lowest quality, the highest yielding property assets still are a significant yield premium to the rest of the property sector, indeed, especially the rest of industrial property. So their portfolio yields 8.6%. And their void rates are still quite high, but they're coming down. And so, you're getting good value there. The shares yield 4.2%, and the income is very comfortably covered because they're getting an 8.5% income on their properties, and they're paying a 4% cost of debt. So there's a good carry there. So that's the fundamentals and the valuation. What about thematically? Why do we like this? Well, economies are recovering. The German economy is actually doing quite well. So you're seeing tenant demand pick up. You're seeing voids coming down, which is this black line here. The amount of empty space in their properties is coming down, which is helpful. You're seeing quantitative easing. You're seeing low bond yields, forcing investors like all of us to look for places to find value. And therefore, we think these yields of 8.5%, 9% on German properties will not be around for very long. And I think it's the wrong price. And I think the final area is you're seeing online shopping driving demand for logistics space. This is better for companies like Segro that have the more prime logistics space, but Hansteen are benefiting from it as well. So that's just one example. I might skip this page, which is a little bit about the structure of Merchants Trust. Wait, I won't skip it. I'll just give you the very quick highlights on Merchants Trust. We have about £111 million of debt. So we have borrowings gearing about 18% of the total assets in the trust, and the portfolio is 700 million invested. The yield, as I said earlier, is 4.9%. And we're currently trading at a discount to net asset value of about 4%. Investment trusts, as you all know, move up and down around the asset value, and they can trade at a small premium or they can trade at a discount. And we're currently at a small discount. We were at a premium for much of last year, actually. But I'll come back to merchants in a minute. Just in terms, and a couple of the slides got in the wrong order, but I'll start here on the themes. Thematically, where do we find value today? Because it's difficult, as we all know, to find really good opportunities because the stock market's doubled in 5 years. Bond markets have been absolutely astronomical. But we are still finding value. We're still finding good opportunities, but not in the whole market, not by any means. One area we like, some of the very largest companies, the mega caps. And this is a hostage to fortune because Glaxo are announcing their results tomorrow. And I have no idea what they're going to say, except they're going to downgrade profit forecasts for the year. But that's the type of company we like. Royal Dutch Shell, BP, out of favour, good, solid businesses, cash generative over time. Maybe at the moment with the oil price, they need to adjust their business to cut their capex down. HSBC, these are good businesses on modest valuations by any historic measure. One other area, I won't go through all these themes because I've only got 20 minutes and I'm running out of time. But one other area is these, what we call recovery situations and turnaround situations. The stock market at the moment loves security, loves comfort, loves quality, loves reliability, and is paying a very high price for companies like Compass Group, Intercontinental Hotels, Bunzl, Reckitt Benckiser. I could name a whole load of companies on 20, 25 times earnings, very high multiples. What it doesn't like is companies where there's a risk. But actually, that's where, if you do your analysis, if you find your good opportunities, you can make decent money. So we like companies in industries that are cyclically recovering, like UK construction. We've been through a hell of a bad time in UK construction, but actually the outlook going forward is much better. So we've got companies like Balfour Beatty, which is itself a turnaround story, or Kier Group. We've got a UK recruitment company, S3, which is where the recruitment cycle's picking up. We've got Hansteen, I talked about, or Carnival Cruises. And then there's also turnaround situations where the management is turning its business around. Ladbrokes is a particularly troubling one, particularly difficult one at the moment. First Group is another company where management are making lots of individual different changes to sort the business out. And because of the work we've done, the analysis we've done, we're confident these businesses will turn around. They won't all work. They don't always work. But when they do work, you can make an awful lot of money. And, if they don't work, if you bought them cheaply, hopefully there's a bit of a a margin of error, a margin of safety in the price you pay for it. So that's just a few of the examples, but I'm very happy to talk later on or in questions or afterwards if anyone wants to quiz me on these in detail. Just in terms of how we're positioned overall, now if you look at many growth and income trusts, you'll see lots of holdings in the consumer staples area, food producers, beverages companies. We've actually got relatively little in that area. Our biggest overweights, our biggest positions that are different to the market are in travel and leisure, which is a whole selection of different companies, which I mentioned a couple earlier. Construction materials, financial services. It's where we find individual companies that are good quality and cheap with a decent yield. And at the moment, we don't have much in the bank sector apart from HSBC, and we've got relatively little in the mining sector. And if we don't like a company, we won't own it at all, like Vodafone or AstraZeneca or the Prudential. And you can see our biggest positions at the bottom of the slide as well. Just the final couple of points on the trust itself. Long-term performance, clearly no guide to the future, but long-term performance of Merchants Trust is good, both in terms of asset value and in terms of share price compared to the FTSE 100 index. Our portfolio has delivered about 3% per annum outperformance of the market over the last 5 years. That's the equity portfolio if you strip out the gearing effect. So we have delivered strong performance from this active conviction stock selection approach. And in terms of dividends, and this is one of the crucial advantages of investment trusts, is you can tuck away money in good years for a rainy day and top up your dividend payments in a tough year. Merchants Trust has managed to grow its dividend every year for 33 years. There were times when income was high and we were able to tuck away money into reserves, particularly 2008, 2009, and we were able to use that money in reserves to pay out dividends in tougher times. So in 2010, the directors had to dip into reserves by about 4p a share to continue the growth trajectory of the dividend. That has been used, those reserves have been used to a lesser extent since then, and in fact, financial year to January 2014, dividend was once again covered, and this year is broadly covered as well. There are still substantial reserves in the trust, 22.6p available, which is just under a year's full year's dividend. So we hope to be able to continue this strategy into the future. That's clearly one of the key objectives of the Merchants Trust, to give shareholders a very steady and hopefully growing income stream. So I will just finish with a few summary points. Income investing works. There's a great deal of evidence that it has worked historically. I think it will continue to work over time for the reasons I gave you. Merchants itself has a good record of applying that and delivering through our active stock selection approach. And as I said earlier, we've got a long history of raising the dividend every year, which is supported by the reserves. There's a lot more information on the website, merchantstrust.co.uk. And we also have a blog, unconstrainedthinking.com, which is not tied specifically to Merchants Trust, but it's my team's blog where we talk about all sorts of odd things that interest us that day or that week. So thank you very much, and I'll hand over.